Wow, first things first with Jay Powell, no papers, no iPad, this time a teleprompter to read off his script. He's changing things up a little bit, but he's also changing some things up with his wording, and this is a big deal. The first thing he says he has his eye on, 8% mortgage rates. Housing was something he really hit on multiple times here. Housing flattened out at the moment. Now his, quote, mind's eye goes to the near 8% mortgage rates and, quote, we're getting reports the effects of this, high mortgage rates, on housing, quote, could be quite significant. That is a big warning flag for the housing market. And it's one that at my startup, which has a fundraise ending today, we are ready to take advantage of. We're kind of excited about that. Bring more housing in the market, but learn about that at househack.com. Read the offering circular. The fundraise actually closes tonight at 11:59 p.m. So learn about that tonight or at househack.com. But anyway, talking about Jay Powell, he vacillated a few times by saying interest rates right now are restrictive, but we're trying to get confident that we are sufficiently restrictive enough. He suggested once that he was committed to achieving sufficiently restrictive rates. It was sort of confusing because he's saying rates are restrictive, so are they sufficiently restrictive? I think he's purposefully trying to be a little vacillating in his wording here, or vacillating in his wording, because he doesn't know. That's the thing. He even went as far as suggesting the summary of economic projections we get at the Fed meetings are good for like the day they write them, and then you throw them away. The dot plot basically has been wrong every single time they've written it. Every single projection they've given has been wrong, pretty much. So who cares about the projections? The point is, what is the snapshot for today? The snapshot for today sounds pretty well like Jay Powell is comfortable keeping rates here and just watching the progress we're making on inflation and jobs continue. Seeing more of that supply chain normalization lead to disinflation. What was really interesting, though, was how he redefined the economy and the next phase. So this is going to take a little bit of thinking. So follow along with this. First of all, he said for like over 2 years now that the economy is probably going to have to grow below trend. Those have always been his words. He's always been saying we got to get the economy growing below trend. And everybody's like, all right, well, the trend is 2%. So what you're saying is the economy needs to go below trend. Well, today, he actually totally redefined this. And this was like yet another Jerome Powell flip-flop. It's kind of like one day the JOLTS report matters, and then the JOLTS report doesn't matter anymore. One day, one survey matters, and the next it doesn't matter anymore. It was like just a few months ago, he's complaining about the employment cost index and how we got to see that come down. Today, he's like, it's pretty good. We're doing good on the ECI, which was actually surprising because just 2 days ago when the ECI report came out, Employment Cost Index, the survey was 1%, came in at 1.1, and Jay Powell's like, that's reaffirming the downward trend. We're doing good here. But going back to this redefinition he just came up with today, I feel like sometimes he just pulls this stuff out of thin air. But anyway, now he's saying, well, we're not actually saying the economy has to go below 2% growth. What we're saying is we want the economy to be below its potential growth. Oh, good Lord. Okay, so how do we understand this? Well, a simple way to understand it is with numbers. Let's say that right now in Q3, the economy is growing at 4.9%. Let's say potential growth for the economy for the next year is 3%. Okay, trend is 2%, potential is 3%. He's saying, well, we just want the economy to grow below that potential now, which is actually a dovish thing to say. And it's probably why towards the end of this event, the NASDAQ started rallying straight up, basically. That's probably why, because Jay Powell's really relaxing this idea that, oh yeah, we've got a lot more work to do on rate hikes. I think we're done. I think by this redefinition, he's made it pretty clear we don't need to keep raising rates. He's comfortable if things continue the way they are, inflation's going to continue trending down. It already is trending down, and he's comfortable that we're on a good trend. However, he also expects it to be lumpy. I kind of think about it like weight loss. you know, like you go exercise a bunch and you're like, why am I not losing weight? Why am I not losing weight? And then all of a sudden it's like you get on the scale and you're like, whoa, all of a sudden I weigh 5 pounds less. You know how like weird and lumpy weight loss is? You know, it's not like you're losing half a pound a day and you're seeing that gradual transition down. That's actually what makes weight loss hard and frustrating, because it's like you work out hard and it's like, it's not changing. Anyway, that lumpiness I think is what Jay Powell's conveying here, that look, like we're doing good. He seemed very bullish about that actually today. Dare I say dovish, like, look, hey, we're doing good, man. Jobs are coming down, into balance. We've got inflation coming down. Let's just stay on this trend. Expectations are good. Oil's not skyrocketing because of the Middle East. Brent is at 84, 82 right now. You realize that's like the trend for the year. It's been a little below, it's been a little above, but nothing, basically no reaction from Israel in oil prices right now, which that's historically what happens when Israel has problems in the Middle East and the oil markets don't react too much, but people thought maybe this time would be different. So far, it hasn't proven to be. The weird thing, though, that he said is he said right now the disinflation we're seeing is probably the supply chain portion of the disinflation. He's worried that that might not get us all the way to 2%, that we're actually going to have to see labor market softening to get the extra like 0.5% or the extra 75 basis points to break us down to 2%. That part I think is a little bit of a risk, but it's not one I think we can really speculate on now because it's so long away. Like, let's get the supply chains 100% in balance. My opinion is you probably don't actually have to break the labor market. That supply chains and capitalism and the disinflation of how capitalistic markets work will drive that disinflation down to 2% without the need of breaking the labor market. I believe that's true because of the decade prior to the pandemic, not just the decade prior, but really the past 40 years of opportunistic disinflation. Now, Jay Powell made it clear, though, that while he doesn't know, that is a concern of his and the committees, that they are going to have to do more in terms of breaking the labor market to really get the last bit of inflation down, that last bit of weight loss, that last little bit of starvation to get to your goal. Fortunately, that's still a ways out. That's probably something we're going to be discussing next year around this time, because we're still seeing the effects of supply chains in the labor market coming into a balance where they're actually leading these price declines or the rate of increases to decline. Remember, we've had a lot of inflation, but that's not the concern here. The concern is the stability of prices and bringing those price hikes back into level. And that's what we're seeing in earnings calls and company earnings reports across industries, with the exception of ski resorts and aerospace, where you still have these supply chain issues. Now, when we look at our bingo card, this is what I got for bingo. We talked a little bit about Congress and a potential debt ceiling crisis, not a lot. We talked about the Middle East, talked about being open to future rate hikes, though I don't really think that is a big thing or a big priority of the Fed. Remember, Jerome Powell opened for the first, at least what I think is in the first time, Jerome Powell opened with, we want maximum employment and stable prices. And he reiterated the maximum employment thing 2 or 3 times, but really threw some emphasis on that maximum employment. I think they're really proud right now that they have maximum employment. Jerome Powell calls it historically significant that they're not seeing the labor market roll over yet. And the fact that now, if you couple a strong labor market with the fact that he's saying, well, we don't have to be below trend, which is what he said like 10 dozen times before. Now he's just saying, we just need to be below potential. That's insane, okay? That is such a redefinition. It's a dovish redefinition. That's just the way to look at it. So we didn't get bingo, at least the way I saw it. We get any kind of talk about fate. I put it in the corner because I didn't think we were going to get that anyway. No Alan Greenspan, no Paul Volcker, no Arthur Burns. We didn't get the willingness to cut without employment going up, because there was no talk really about even talking about cutting. No iPad, he was on time. The recent surge in yields, yes, does some work for us. The tightening of financial conditions, yes, does some work for us. We did get this below trend growth discussion, which is what we've already discussed. Brief mention there of the UAW. No real talk, though, about that turning into wage inflation. Doesn't really matter because we didn't get bingo anyway. Goods disinflation continuing. We didn't get talk about that. We didn't get talk about housing disinflation, but we got hints that there was going to be some pain coming to the housing market. Again, I think that's going to be a great opportunity for HouseHack. We're really discriminatory with our deals right now, picking up on fear, and it's a great opportunity. Like, for example, we just got a house, almost a model match to a house that's sold next to a busy road for $817,000. We got it for $605. This is like crazy. I mean, how much money is in that spread? And that's insulation in the event market. It's correct, right? It's great. Anyway, deflation. We didn't mention deflation. We didn't mention disinflation, services disinflation. We just didn't have that discussion today. He was asked about a pause. He didn't use the word pause, didn't use the word soft landing. This was a big deal. He said they did not put recession back in their forecast. They have little forecasts in the background. They didn't talk about recession being back in. And that's, again, why I think, if a recession is going below this 0 level right here, if that's a recession, and trend growth is right here, 2%, and right now the economy is at 4.9%, and maybe potential's like 3%. He wants us to be around here, which means we're not really knocking on the door of recession, as Jay Powell says, in the short term or in the near term. So they're not seeing a recession. And there was definitely a time last year where Jay Powell's like, yeah, we might be going into recession. Obviously, we touched on banking stability. That was pretty basic. We think that bank term funding program will last for a while. Increase the supply of workers, 25 to 54, big increase over here, supporting some of the easing in labor. No pressure on JOLTS having to come back in balance. Remember, he's kind of flip-flopped on that, which is great. We'll take it. I love the redefining of below potential because it's bullish. It implies a less hawkish Fed going forward. We also are seeing Treasury yields fall right now. What we should look at is the Fed rate monitor just to see what the December forecast is looking like. My guess it's going to go lower from a 25% chance to lower. The 10-year is plummeting right now. Could be a time for TMF. Look at ticker TMF. But this is not personalized financial advice for you. TMF should be doing well with an 11 basis point drop in the 10-year. The 2 years dropping 13 basis points. This is actually wait a second. When the 2-year drops more than the 10-year and both are going down, this is a bull steepening. Yield curves right now are telling you bullish steepening of the yield curve. You could Google that one. It's a little complicated and annoying and how it's all calculated and stuff. But once you know it, it makes sense. But the bottom line of it is that's what you want. A bull steepening. You do not want a bear steepening. A bear steepening is where you have less inversion, but it's because the 10-year is skyrocketing. That's what we just went through the last 2 months of hell in the stock market. So the bull steepening, that's actually good. Every meeting's basically going to be live. That's not a surprise that they'll sort of decide meeting by meeting. What does the monitor say right now? The monitor for December, it just dropped from 25% chance of a rate hike to 20%. In January, just dropped from a 32% chance of a rate hike, actually 36% chance of a rate hike, all the way down to about 26.7%. So you're definitely seeing a compression there. I think this is extremely clear that the Federal Reserve is at peak unless some data comes in like really crappy. November 13th is when we're going to get our next CPI report, but I really need you to mark your calendar for this Friday. Obviously, today we have the expiration of the HouseHack fundraise. Email us at ir@househack.com if you have questions, ideally before 5, so we have time to respond. But anyway, I'll be up all night, probably just responding to emails and trying to help as well. But this Friday, you need to pay attention. We'll be covering this live, 5:30 a.m., non-farm payrolls, okay? Payrolls report, we're expecting 0.3% increase in month-over-month average hourly earnings, up from 0.2 in the last. I expect the year-over-year to be 4%, and the change in non-farm payrolls to be 180,000. Again, him thinking that we will need to see some kind of additional disinflationary work from the jobs market is just going to mean higher for longer unless supply chains can do all of the disinflation for us. No recession back in the forecast. The housing warning was very, very clear today. Availability of goods and autos higher, but durable goods spending lower. Surprise, surprise, those are like cars and washing machines or solar panels or whatever. All those obviously just wrecked right now. Some people say stay the hell away from all of those. Other people say it's a great time to be buying those. Let's see here. Looking at the yield curve is confusing sometimes. Looking at some of your commentary here at AMD 108, AMD. It just shows you when you have a good earnings report and then it goes down in after hours and skyrockets the next day, the stock market is insane. That thing's almost up 10% right now. I've got a position in AMD and NVIDIA. Let's see here. Great, thank you so much. Okay, good. Yeah, hey, look, thank you so much, everybody, for being here. This is fantastic. What is this? Somebody's talking about HouseHack raising at a 1-to-1 valuation. Let's go, HouseHack. That's true. That's almost unheard of in the venture capital space. I can't think of another company that's ever done that. Yep. Okay, good. So that's it, folks. I really appreciate you being here. I love y'all. Look, I know it's shitty times when the stock market goes down. You know, everything feels like crap. When your portfolio's going down, it's so hard. But I really want y'all to think to yourselves, you're going through life with a shield, and you're getting beat up. Okay, like everything's beating on that shield hard. You gotta keep putting one foot in front of the other. We're gonna get through this. You're not gonna forget this time of your life, though. I promise you, this is gonna be a time when you look back, you go, damn, that really was a hard time. It's supposed to be. It's supposed to be. And it's because of the crazy money printing we had, because it's basically the hangover. You know, we partied so damn hard in 2020 and 2021. Now we're dealing with like the 2-3 year hangover, and hangover sucks, man. Like you just want to like lie on the floor and like go to sleep, and you got a headache and your tummy hurts. It's like, it all sucks, but keep going. Like we're gonna get through it, okay? I love y'all, and I wish y'all the best. Now let me read this crap. Even though I'm a licensed financial advisor, licensed real estate broker, and becoming a stockbroker, this video is neither personalized financial nor real estate advice for you. It is not tax, legal, or otherwise personalized advice tailored to you. This video provides generalized perspective, information, and market commentary. Any third-party content I show should not be deemed endorsed by me. It's just commentary. You gotta look at that yourself. I'm not vetting the information. This video is not and shall never be deemed reasonably sufficient information for the purpose of evaluating the security. And I personally operate an actively managed ETF and hold long positions in various securities, including those that have been mentioned in this video. Potentially, oh yeah, and I have to say that I have no relationship to any issuers, nor am I presently acting as a market maker in any of those publicly traded companies. Good Lord. Thank you so much. Appreciate y'all. We will get through the hangover, I promise. We will do it together. Everybody will have their own strategy, but we'll do it together, and I ain't going anywhere. I'm not leaving. Thanks so much. We'll see you soon. Bye.
Why not advertise these things that you told us here? I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.